earnings met the expectations more or less on the consolidated front. Now, if you look at the revenues, we saw 18% growth for the consolidated entity for Tata Motors. EBITDA was marginally higher by close to 4%, coming in at 11,250 crores. Margins for the consolidated entity stood at 12.3% versus a level of 14%. So we saw some margin contraction on a year-on-year basis. Of course, that was anticipated. But the standalone performance was a dampener. So we had the standalone revenues, despite a 46% growth there, we saw the margins come in at only 5.6% versus a level of 4.8%. The street was anticipating a margin figure of close to 8.5%. So that was not met. Also, they posted a loss of 500 crores for the standalone entity. Of course, there was a one-time impairment charge because of which we had the overall earnings for Tata Motors getting impacted. Also, on the JLR entity front, we had the pension credit of close to 437 million British pound. And the total provisioning that I was talking about for the standalone entity for impairment, that was close to 963 crores. So these were the two big adjustments as far as Tata Motors earnings were concerned. Of course, the management is quite confident that moving forward, the key geographies should do well. Of course, the situation in UK and Europe remains, quite weak when it comes to the demand for luxury cars. So that is one area wherein probably, the stock would face some, pressure points in terms of the earnings visibility. But clearly, if you look at the fourth quarter earnings, it has more or less met the street expectations. The street would be probably disappointed with the operating performance of both the standalone entity as well as JLR.